So welcome everyone, and thank you for joining us today for this REF webinar on 1031 exchange strategies and tax deferral mastery. So whether if you are a seasoned real estate investor, a developer, or a business owner looking to maximize your returns, you are in exactly the right place. So before we dive in, a few quick housekeeping notes. I'll be your moderator for today. So today's session will be starting now and it ends at 5 p.m. So if you have any questions, please raise your hand or please drop your question in the chat. Lou Ann will be answering your questions at the end of her presentation. So it's my pleasure to introduce today's featured speaker, Lou Ann. She is the Regional Development Director for Exchange Resource Group, a nationwide qualified firm helping investors legally defer long-term capital gains, tax and depreciation recapture through the 1031 exchange. She has over 20 years of experience spanning the title industry, reinsurance, and real estate. Lou Ann began her career at Lloyd's of London, and she has since become a trusted resource for investors, developers, and brokers across the country. She has been with the Exchange Resource Group for the last 7 years.
12
years. Wow.
we got to change that.
Yeah, that's great. So that brings a lot of experience for us today. So please join me in welcoming Lou Ann. Lou, the floor is all yours. You can start.
Thank you. Welcome, everybody. I know I've done business with some of you, but I'm very, very happy to be here. And we're going to start. I'm going to give you the basics of the 1031 exchange. We could talk for 2 hours about all this, but I don't want to throw too much at you at first. So my name is Ann Blough. Exchange Resource Group is in Denver. I work for 3 real estate attorneys and have for 12 years. So my office is in Carrollton. 972-863-1031 is my number. And my email is luann@erg1031.com. Next slide, please. All right, so we're going to go over why in the world would you want to use a 1031 exchange? I don't know, not everybody knows how to figure out their cost basis, but when you have an investment property and you get ready to sell it without the 1031 exchange, you're going to pay tax on the difference between your cost basis and your sales price minus your closing costs. So if you bought a property, we'll just use a simple example because I want to show you how to figure out your cost basis. Yeah, that's okay. Next slide is fine. So if you bought a property for $100,000, you added $50,000 of capital improvements, and you had $25,000 of depreciation. You take that initial sales price, add your capital improvements, subtract your depreciation. That number is your cost basis. And when you sell it, you're going to get taxed on the difference between your cost basis and your sales price minus closing costs. The federal long-term capital gains rate is 20%. Here in Texas, we don't have a state capital gains tax. There are 6 states that don't have a state long-term capital gains tax. Anybody on here from California, you're going to get pounded with their state capital gains tax. It's like 14.8%. So you add that to the federal, plus without the exchange, you're going to be taxed 25% on what they call depreciation recapture. So that's the total amount of depreciation. So that's basically why you're going to want to use a 1031 exchange, is to defer all that tax and put it into new real estate. I'm going to show you these examples, and these are my little monopoly houses, so forgive that. But let's say you have investor A and investor B. This shows the property value at $100,000. We're going to go that they had a initial purchase price of 0 and a cost basis of 0. So they have the potential of $100,000 of gain. So investor A is going to do an exchange defer the tax rate of 20%. We're in Texas doing this. Pay zero tax. After tax, they've got $100,000 cash to reinvest. They put 20% down on a new property. They can buy $500,000 worth of property. Whereas B says, nah, I don't want to be bothered by that exchange. So they go ahead and pay the $20,000 in tax. After tax, they've got $80,000 to reinvest. New property, 20% down. They can buy $400,000 worth of property. Next slide, please. All right, so we're going to assume that these properties go up in value 5% annually. Again, this is an example. So at the end of 5 years, and why you should continue on the 1031 exchange train. So investor A, after 5 years, his or her property is worth $638,140. B is at $510. They sell again. A defers the tax. After tax has $138 to reinvest. Qualifies for almost $700,000. We're not including depreciation recapture in this. Has paid zero tax. You look at the numbers for B. They qualify for $442. Paid $42,000 in tax plus whatever depreciation recapture is. Let's go to the next slide. So let's say they keep holding the tax and they keep going. You can look at the numbers at the end of 10 years. It's a great disparity. A is at 881, B is at 564. They go forward. A has qualified for almost $1 million. B is not quite at $500,000 and has paid $66,000 in tax. So let's say you started really early. Let's go to the last slide on this one. There you go, thanks. So you can see if that you started really early and you just kept on deferring. At the end of the day, look at A would have 3.6 million, B's at 802. Now, if my boss, Dan McCabe, was here, he would say, defer, and you die. When you leave your properties to your heirs, they're going to inherit the property at the value of the property on the date that they inherit it. So with the 1031 exchange, had investor A cashed out, they would have had to pay the tax based on the cost basis, whatever we figured that out to be. But if they die after 20 years, then 3.640285 would become their new cost basis, and their heirs would not have to pay any of the long-term capital gains tax unless they held the property and it went up in value. So that's called a stepped-up basis. It's a great way to reap the profit of real estate while you're alive, and then leave something very, very valuable to your heirs. All right, let's go on. I know you're going to have questions about this later. Okay, there are 6 requirements. I've actually added a 7th. You have to set up a 1031 exchange before you close on the sale. You can't sell a property and then call me 5 days after and say, oops, I forgot to set it up, because you would have had constructive control of the money and we can't help you then. But the other rules, and we're going to go over them one by one. The property has to be held for investment. There are timelines with the IRS. There are always timelines. We have the 45-day rule and we have the 180-day rule. You have to use a qualified intermediary. That is an independent third party to facilitate the exchange for you. That is what we do. There are requirements for how you take title, and there are requirements for how much you reinvest in the next property. It's called the equal or up rule. We'll go over them. Okay, so any property held for income or used to produce income can be exchanged for investment or any income producing property. A lot of people think that this like-kind exchange means if you sell a single family, you have to buy a single family, and that is not true. It's anything defined as real estate can be sold for whatever, and you can buy anything defined as real estate in any state in the country. It doesn't have to be Texas to Texas or California to California, but it must be domestic. Guam and the U.S. Virgin Islands also qualify, but not Puerto Rico, not Mexico. So, all right, forms of investment property. Rental property is always an investment. Bare land is always an investment, even if it's not income producing while you own it, because why else would you buy a bunch of dirt unless you were buying it hoping that it would appreciate? And there's a bunch of land appreciating right now. I'm doing a lot of business up in Salina, Texas. People have held their land for 20, 30 years, and the value is amazing. Okay, next slide, please. So here's an example. We kind of dropped the E off the end of this in the slide. I'm not sure why. But Mike and Mary own a duplex they bought in 2010, so they've owned it 16 years. They've rented it out ever since. Now they want to sell it and buy a place at the beach to rent out to others and use themselves a little bit. Can they do a 1031 exchange with this? And the answer is yes, they can. The rules with rental properties like that, where they want to use it a little bit themselves, is it's 14 calendar days out of the year or 10% of the number of days that it's rented. So if it's rented 250 days, they can use it 25 days. And a lot of people will figure out ways they need to make repair trips down to wherever their property is, and they can extend their stay a little bit. Okay, next slide, please. Okay, with the exchange comes the 45-day rule. What the IRS says is you have to identify a list of replacement properties within its 45 calendar days from the date you sell. After day 45, there is no grace unless we have a federal disaster, which we had during COVID. We've had tornadoes, we've had hurricanes. It's very county specific. But for the most part, day 45 is that cutoff. We will send you a form, and you must return that form to us by day 45. It is not filed with the IRS, but it's kept in your file for your CPA, and in the dreaded possibility that you might get audited someday, you want to have record of that. You can close on a property before the end of day 45. A lot of my people now, they know the sale is going to go through. They're finding their properties before they sell. They're under contract. We put everything together. The money hits the exchange, and then we close on it 5 or 10 days after they sell. So how many properties can you identify? This is a little bit complicated. So you can identify up to 3 different properties or follow the 200% rule. If you're going to identify more than 3 properties, so say you sold for $500,000, you identify 1 or 2 or 3 properties, they can be $2 million each, if that's what you choose to do. Once you identify 3, the 200% rule kicks in. We have to multiply your sales price times 2. So 500,000 times 2 is $1 million. And then the total purchase price of all those properties you ID cannot be greater than $1 million. And again, no extensions. It may only be extended by a presidentially declared disaster. So I'm going to give you an example of this because it's a little bit tricky. Next slide, please. Okay, so Jack and Jill sell their rental for $800,000. They want to identify 2 or 3 replacement properties for $2 million each. Is this allowable? If I was, if I had you, sorry about these little technological. If I had you in a class in person, I would say, what do you think? Well, the answer is yes, and that would be the next click. It is, because they're only identifying 2 or 3. If they had gone over 3, then we would have a problem because their cap would have been 1.6 million. So yes on that one. Let's go to the next one. Brad and Jennifer sell a property on January 1st for $100,000. Brad wants to identify 4 little condos selling for $75,000 each. Is this okay? No, it's not okay because they're over 3. So their cap would be $200,000 unless all these little condos are next to each other, contiguous, and they do it in one closing. Then we could count it as one ID. Okay, next slide, please. Okay, the rule for closing on a property, you have to close on one or more of the properties that you identify by day 180. That 180 starts on the same day as the 45. So from the date of closing, you've got 180 days to purchase one or more of the properties. We don't run into problems with this unless you've identified a new construction property that isn't built yet, in which case I will probably try to talk you out of that because of experience and failed exchanges. The other time we sometimes run into this if the property that you want to purchase is in probate and it gets hung up in the courts. But there are no extensions, again, unless we have a presidentially declared disaster. Okay, next slide. Okay, keep going. All right, so what do? We are required by the IRS, and the only requirement for a qualified intermediary is that we provide a qualified escrow account. Qualified escrow account means the money is held in a separate account. One of the real estate attorneys I work for, Dan McCabe, has been an attorney for 40 years. He's doing consulting for us now. His son runs our company. He saw a lot of fraud back in 07, 08 with 1031 exchange companies that kept the money in-house and commingled funds and invested it in the stock market, and then everything crashed. So we will hold your money in a qualified escrow account in one of 2 banks that we use. It will be an account just for you. It will say Exchange Resource Group as qualified intermediary for you. Okay, next slide. I can't remember which order these are in. All right. So we must hold your funds in a qualified escrow account, which we do. We require the signature of you to move any funds. So when you get ready to buy and we set up the exchange on the buy, we're going to send you a wire form and you have to tell us how much money you want us to send. We sign off on it, you sign off on it, and the bank signs off on it. That's a 3-signature verification. And we also call and verify wiring instructions before your money is sent. The third requirement is they must be easily accessible to answer questions at no charge. Anybody who has dealt with me will agree that I'm easily accessible to answer questions at no charge. I talked to a client in California last night at 6:30. There are exceptions on Sundays when there are football games involving the Washington Commanders and my son, but we'll talk about that later. Okay, next slide. Now we've got requirements for title. So this can be a little bit tricky, I have found with, Robbie Polischetti, are you on here? Somewhere.
I don't think he's here, Lou.
Is he not here? Okay. What about Ravi Kumar? No?
No, I don't see him.
Okay, all right. So however the taxpayer holds title to the old property is how the taxpayer must take title to the new property. So if you own a property in an LLC and you want to buy something else, you need to have your taxpayer ID showing on that purpose, on that next property. This can be a little bit tricky with syndications, the way some of the deals are set up. And we don't have enough time today, I don't think, to go into that, but we can at a later time. So the IRS requires that you buy something defined as real estate with the same taxpayer ID that is on the property that you're selling. Okay, next slide, please. And now we're going to talk about how much you reinvest. So a lot of people who call me think they only have to reinvest the amount of their equity or the amount of their profit. And the IRS would not make it that easy. So to completely defer the tax, you have to reinvest the amount of proceeds that go to your exchange account, which would be net of your closing costs, plus the amount of whatever debt relief. Another word for that would be a note payoff. That is your reinvestment goal. So as an example, say you're selling a $300,000 property, you have a $150,000 note, and you have $30,000 worth of closing costs. Your reinvestment goal is going to be $270,000 because the exchange will get $130,000. The note payoff is $250,000. So you have to buy property or properties with a value equal or greater to about $270,000, and you also have to spend all the cash. Although if you don't, it doesn't blow up the exchange. It just means you're going to pay tax on the amount that you don't reinvest, on the difference between what you spent and what you should have spent. Okay, next slide. These are not really problems, they are challenges. So corporations can do exchanges. It's just got to be the taxpayer ID for the corporation. Partnerships and LLCs can do exchanges. Again, the taxpayer ID for the LLC, unless we drop some of the members of the LLC out, and then they can do their own exchange. Trusts, as long as it's the taxpayer ID for the trust. In tenancies, let's go to the next slide for tenancies. Oh, okay, I took that one off. So if you bought a property with somebody else, a great way to do it would be to buy it tenant in common. Say you had 3 people that wanted to buy a property. So Sandy, I'm looking at you, I'm looking at Sunny, I'm looking at Vineet, and I'm sorry if I'm mispronouncing your name. Say you wanted to buy an office building. You could together, if you each took title to whatever portion you were going to buy with your own taxpayer ID. You couldn't form a separate LLC and take title to that property under that. But tenant in common is a great way to buy property, because then when you go to sell the property, say 5 years down the road, you are not confined by what the other people in the LLC want to do. You can take your portion of the exchange and go your separate way and buy something else. Okay, so now consolidation exchanges. If you have several different properties and you want to sell them and you want to buy something else, you can absolutely do that. You just have to work with the time frame of the 1031 exchange. So your 180 days would start on the date of the sale of property number 1. Diversification, same thing. You have one large property, you want to sell it, and you want to buy several small properties. Again, we'd have to keep an eye on the timeline. Retirement needs, I'm going to show you a really cool example in these next couple slides about how you can use the 1031 exchange to set up your retirement needs. And then I think we're all in this crazy business of real estate because we want to maximize the yield on our investment. Okay, next slide, please. Okay. So this is actually, oops, yep, right there. This is actually a friend of my boss's boss, Dan McCabe, who, and they're in Colorado. That's actually in southern Colorado. he has some friends that owned the farmland, which you can see. They also own a homestead, which you cannot do 1031 exchanges with in this example. So their neighbor came to them and said, we want to buy your property. We want to buy your land. And they were getting a little bit older and they thought, I think that's a great idea. We're tired of doing this. They'd owned the land for years. They had a tremendous amount of capital gain and potential tax. They also have 3 adult children with families. So you can see those arrows pointing to the 3. They went to the 3. They said, pick out something that you want to own or manage now, and then potentially after we're gone. So adult child number 1 chose a bakery. Adult child number 2 chose the biggest rental house I think I've ever seen. And adult child number 3 chose 3 townhomes. But because they were contiguous, they were together, and they were able to buy it from the same seller at one closing, we were able to count it as one identification. So they sold the land, put it into the exchange, bought the 3 properties, mom and dad, and they eventually sold their house. But mom and dad get the income from the bakery, the rental property, and the townhomes while they're alive. And then when they pass, those properties will go to their heirs at the stepped up basis. So their heirs will inherit the properties. They won't have to pay any tax unless they hold it for a while and it goes up in value. Then they'd only have to pay the tax on the difference between the value when they inherited it and the value when they sell it. I think this is my favorite slide in the whole thing. Okay, next slide. All right. So a lot of people wonder about their homestead. We'll answer that question at the chat. So we have Dick and Jane, and this is actually Dan's brother and sister-in-law. They owned their home for many years and have $1 million worth of gain. This was a home in Boulder. They bought a lot in Boulder 40, 50 years ago for about $100,000. I don't know if you could even buy a parking lot space for that now. It went up in value. It got to $1 million. So how do they exit this property without owing any tax? Let's go to the next slide. You got another one? Janine, you got another one? There you go. Okay, go one more. Go one more. Okay. So with your homestead, if you're a married couple, you don't have to pay any capital gains tax on the first $500,000 of gain if you've lived in that house for 2 of the past 5 years, which they had. But once the gain got over $500,000, they were going to be stuck on capital gains for the next $600,000. So what they did is they rented out their property for 2 years. And they moved to Spain. You don't have to move to Spain to do this. He's a professor. And then they came back. So they were able to put the $600,000 into the 1031 exchange. They took what we call boot of $500,000. So you can take money out of a 1031 exchange and not pay tax on it. You just have to do it at closing. So they took boot of $500,000, used the Section 121 exclusion, had 0 tax. They put $600,000 in exchange. They bought a rental property. They leased that rental property out for 2 years, and then they did a change of use, which you can do with. So they exited that sale or that potential gain on $1 million, paying nothing. And it was perfectly legal. I have some people that do this as a career. They'll sell their exchange property, they'll go move into something else, live in it long enough, and then move on down the road and keep doing it. Okay, next slide. We could do a whole class on reverse exchanges, and I think a couple of the questions are going to be on reverse. So I'll just hit it real quickly. What happens if you've got several properties to sell? And this lady in California I talked to today is a perfect example. They have 6 office buildings or apartment buildings in Long Beach. They want to get out of California. They want to come to Texas. They're concerned about the timeline. So with a reverse exchange, we as the intermediary can purchase that property through an LLC on your behalf. So we're going to set up an LLC in Texas for them. It will be the lease back, everything will be to them. We just are setting up this entity to facilitate it. We will take title to that property on their behalf. And then that will give them 180 days to get the other property sold, at which time we will flip the exchange back to them. They will become the owner of the LLC, and they will not have paid any tax on those buildings, and they will have gotten what they wanted. And that's a very simplified example. I have a pretty complex brochure that I can share with you guys on this, and we can talk about it in the chat. If you want to do construction and improvement exchanges, that we would have to do in the reverse format, but it would allow you to do improvements, do some new building on the property you're buying, as long as we stay within the time frame of the 180 days. Shifting the date of gain recognition, I have some people to do exchanges in the last quarter. They have no desire to buy any new property. They just don't want to have to recognize the capital gains until the following year. We've talked about integrating it with estate planning, and we've talked about combining 1031s to create tax-free income. Let's go to the last slide, I think. Okay, so my office is here in Carrollton. We have an office in Florida, and we've got 2 in Colorado. I will be your contact person. We have a Facebook group, erg1031.com. I also have a Facebook group that's not on this slide, but it's something I set up. It's called 1031 Exchange Assistance. And we've got 3,200 people on it, which kind of blows my brain. But we just discuss various issues or situations that come up with the exchange, and I'll occasionally post these rules and how we go through them. But if you want to join that, just shoot a request, tell it it's going to ask you questions at your investor, and you'll be automatically added. So that is all I've got from the slides. I have thrown so much information at you guys, and I know that you're going to have a lot of questions.
Yeah, thank you, Luann, for the great presentation. It's really very informative.
Good.
So we'll now open it for Q&A. There are a couple of questions in the chat room if you want to answer them.
Sure. Do I log into the chat, or can you ask me?
Oh, okay.
I'm not sure where the chat is on this platform, sir. Oh, wait, maybe I do. No, because his screen's up. I don't think I can access them. Would you mind asking them to me, and then I'll just answer them?
Sure, that's fine. So Srikant, he's asking a question. Can I sell a property which I bought in my name via syndication and reinvest that in 1031 exchange?
I knew that was going to come up. So in a syndication, you have a taxpayer ID for the syndication. So when you're in a syndication, you technically don't own real estate. You own a share of the entity that owns the real estate. So the answer is no, you cannot 1031 exchange yourself out of the syndication unless the syndication is willing to deed you out of the syndication into the entity that you've been getting K1s in. So if you've been getting K1s in your own name, the syndication would have to deed you out, and you'd have to show on title in your own name at the time of sale. If I wish Robbie Polischetti was on here because we did one for him last year.
Thanks, Luann. This is Shrikant. I'm the one who posted the question. Is
Oh,
it
hi.
okay if I post my extended questions, or do you want me to reach out to you separately in the interest of time?
Well, it's 4:40. We have till 5. What do you think, Sandy?
Okay.
We have, can go ahead.
Go ahead.
Sure, Leon. So here is the situation, right? So, I've been with them for a while now. We've been, investing via syndication.
Okay.
So every time they do send me my K1s at the end of every year, right? And, whenever they, invested, I sold a property and, I reinvested the same thing without taking out via 1031 onto the next property with the same company. So it's going on like that. Now I would like to cash out and put it in a different essentially home construction. But I'm not sure. So essentially, the syndication which I invested in right now, that's a retail rental, right? So if I need to take out money, and if cannot do it via LLC, that's fine. I can still put it on my own name. But my main question would be: is it okay if I take out that money from the syndication, which has been invested in the retail rental sector,
Are they
and
selling?
move it to the
Are they
house?
selling? Are they selling the property?
I want to cash out because, I have a different opportunity, the home construction, which is more lucrative and, kind of offers me other advantages. So I'm thinking, what happens in this scenario?
They would have to. Well, the property would have to be sold. It would have to be a sale. They would have to get you out. So the taxpayer ID for the syndication is what you are on title for. You're not on under your same name or your LLC. It's just that taxpayer ID.
Right. So, what if I want to sell my share to the other investors in that syndication? So, essentially, the syndication itself is not selling the whole property. But since I want to cash out, I spoke to them and I said, if any of the other co investors are interested, you can just go ahead and sell your share to them.
But the property, okay, we'll talk about that separately. Okay.
Okay, sure, Leon. I'll reach out to you separately then.
Yeah, we'll talk about that separately. Because you don't really own real estate right now. You own a share in the entity that owns the real estate.
So if I cash out, what are my options for 1031? What can I do with it without, what opportunities are eligible as 1031 exchanges if I come out of that syndication company?
If they'll deed you out and they're selling it into your own entity, then it's possible. We'll talk about that. Okay. Next question.
Yeah, so next question is by Chandra. He's asking the question, does the capital plus profit go into the exchange, or is it just the profit?
It's the amount of the note payoff plus the proceeds. So it's not just the profit. It's the whole amount. Well, I mean, the cash is going to go into the exchange, but you have to reinvest the whole amount, the amount of the note payoff plus the amount of cash that goes into the exchange in order to totally defer the tax. If you don't, you're going to pay tax on the difference, and we'd have to work that out and see what that looked like. That's a very common question.
That makes sense. Thank you, Luan. And another question is, can we do 1031 exchange from a group investment into another group investment?
If the taxpayer ID for the first group is selling the property and buying the next property, it kind of goes back to the first question. You'd have to go along with the whole group unless they're willing to deed you out. If they're willing to deed you out, then you'd have to buy into another investment, but you'd have to buy into it tenant in common. because that group investment might have its own taxpayer ID. I don't know. Does that make sense at all?
Yeah, it makes sense.
Right. Right. The
Hello.
other, yes. While talking on that, so the taxpayer ID is dependent on the syndication company and not on the individual investor who invested in that syndication company, correct?
That is correct, which is why if you were going to do it in the syndication, the taxpayer ID for the syndication would have to sell and be on the net and also be on the next file.
Understood.
Unless they deed you out into the taxpayer ID or the entity that you have been getting K1s on.
Right. So,
That's
but
called,
what?
it's called a drop and swap. That's why I wish Robbie was here. We did one for him last year. I think there were 19 members. So
Right.
they deeded every single. Were you on that one? Shrikant?
No, not right now.
Okay.
But yes, that's one of the options that I told you earlier with him.
Yeah.
So that's the reason, I just wanted to check.
Well, he
And
was willing to do that. So every single member, it was a lot of work, but it's just done with a deed, a warranty deed. He was willing to deed out, or the syndication group was willing to deed out every 18 went into something else themselves, bought something else.
right, okay.
Okay.
And if the main company opens LLC for each property, so let's say the company is the same, it's just that I invested in property A, now they sold it. Now, if I have to reinvest in the company B, which is LLC B, but under the same parent company, right? Now the taxpayer ID, would it change for company A and company B, even though if they are under the same main management company?
As long as the taxpayer ID for A is the same as B and you're in there, it's usually it can be a little bit of a challenge to make sure all the members want to go forward. But that's totally up to the syndication and the group.
Gotcha. So it's
Lou,
a
I think it has to do whether the parent company is the where they paid the taxes and the LLCs is disregarded or non-disregarded LLCs also comes into the picture. That's what makes into consideration. Just an add-on.
Okay, I'll take that.
yeah,
I'm
thank
not
you.
above getting
This
more
is
information.
right.
So
This is very informative. I just wanted to check, do you guys run like regular sessions like this, or is it one of the bad, suddenly just did it all of a sudden? Or do you guys run regular sessions? Because I do have like few other folks who have some questions, and
I
I
am
was
happy.
asked to attend these sessions.
Yeah, I'm happy to do a webinar for your group.
Oh, okay.
We
Yeah,
just,
it's not
we
like
just have to
many of us,
schedule
it's
it.
just the four
We
of
would
us.
just, yeah, well, we would just have to schedule it. Education on this is the key. So
Gotcha. Gotcha. And do you run like sessions like this, like more like open sessions where you're showing us the details, like slides and answering questions? Do you guys do these kind of sessions often?
yeah, this is a slide presentation that I've done probably 6 or 7 times. We're the vendor for a group called Lifestyles Unlimited. I don't know if you've ever heard of that, but
Right.
it's a big nationwide investor group, and I do individual sessions for a lot of their groups.
Sure. And I came via the WhatsApp group. Are you part of it, or is there a person that I could talk to on the WhatsApp group I came from?
Say that one more time.
I was asked by one of the persons I know, and he posted and said, like, hey, this session is happening, so you can just go ahead and attend this session. That's how I attended here. So there is this person called VD who posted this message in that WhatsApp group. So if I need to reach out to him,
This is the RE forum. So Vinny is the one who invited me to present this, and I am a member of that.
Hello.
and
Hi, Shigan. This is Vedi. Yeah, so like we host webinars oftenly in REF, and majorly it is registered on our app. And yeah, we conduct at least two to three these open webinars with different professional in the industry. And like I'm the admin for REF, and I post in all the WhatsApp groups.
Oh, so VD is Vinit Durya. Okay, thanks, Vinit. Thanks for the
Yeah.
confirmation. So, in case if I have more questions, or if my group needs more sessions, are you the one should I'll be reaching out to?
Like for 1031 exchanges, it would be better if you reach to Luann directly. I'll share her contact details and her business in the
Okay.
groups just after the session. And like you can see what sessions we have hosted in our REF app. And like we will be like scheduling more and more educational and informative sessions for the industry as we move forward.
Sounds good. Thanks, Vinit.
Thanks, Sikant.
Any other questions from me? We still have a couple more minutes.
We can, as long as you don't steal them. Yes, we can.
Yeah.
And I can also send you brochures, explanation on the straight exchanges and the reverse. I'm happy to do that if you want to email me.
Sure. So
Lou,
we
one last quick question. In an LLC, how much percentage of ownership can they drop, and then the LLC can continue in reinvesting using the same federal tax ID?
It's up to y'all.
Okay,
There's really no limit.
okay,
Oh, how much
got
do
it.
we charge? So that's a great question. So if the property, and again, I don't know where y'all are coming from as far as single family or multifamily, property value is up to $1 million. Then we charge $950, including the work on the sale and one purchase. And additional purchases are $250 after that. After $1 million, I'm supposed to charge 0.1%. So if you sold for 2 million, I'm supposed to charge 2,000, but I usually don't. I come down off of that. So yeah, we could, that's under $1 million, it's not negotiable, but over $1 million, it's a little bit negotiable.
Maybe I posted my question in the wrong way. No, I'm trying to ask you, let's say there is an LLC, there are 10 partners owning 10% each, but let's say 4 or 6 of them wants to go and reinvest. Is there a minimum percentage that needs to be that needs to participate, or it can be just 2 people take that federal tax ID and reinvest? The other 8 people can walk away, do whatever they have to do, pay their taxes,
Correct.
whatever the consequences. Okay. It can be any percentage, but the federal tax ID has to go and reinvest.
Correct.
Got it.
couple more questions from the chat, Luan. So Vineet has all the presentation slides. Is it fine if he shares with everybody? Are you
That's
okay?
Yeah, it's fine.
Okay, great. So Rajendra will be sharing the slides as soon as this session is done. And the other question is, how much do you charge for 1031 exchange?
I think I just answered that.
Can you say that again, Luan? Maybe a few folks joined late.
Sure. The property value is up to $1 million. So $1 million or under, it's $950, including the work on the sale and the first buy. And additional properties are $250 each. From $1 million up, I'm supposed to charge 0.1%, which would mean, a property at 5 million would be 5,000. I'm not going to charge that much. We'll negotiate after that. But that's the basic fees. Reverse exchanges are more expensive. They're a lot more work, and there's a lot more involved in that. So they're going to be more expensive.
Okay, thank you. Any other questions, anyone? We can take one more question. Okay, we have one more. All right, Srikant, you want to ask?
Right. So, Luan, talk about the different situation here. So, let's say I invested directly, not via syndication. I invested on a house. Now I need to sell it, reinvest it via something else. So when I reinvest it, does it have to go with my SSN and my taxpayer ID, or can I now establish an LLC and
You can
put it via?
you can establish an LLC as long as it's what we call a disregarded entity. So it's going to be a single member disregarded entity. So it's still going to pass back through to your personal tax return, but
Right.
it can be in an LLC.
Right. And how about, can I add members to it? So let's say another 2% was to invest.
No, the only one you could add to it would be your wife, your spouse.
Gotcha.
Because if you file a joint tax return, then you're technically one in the same taxpayer ID.
Gotcha. So if my friends want to join or chip in into the new property, so they need to come with their own LLC. So we'll have.
They need to come tenant in common so that you all show separately on title.
Gotcha. So do we need to, let's say 3 of us, so we need to have like 3 LLCs total under one more parent company that's investing?
3 LLCs, you don't necessarily have to have a parent company. You can just form an entity that doesn't have a taxpayer ID to handle the operating expenses. But each 3 would need to show on title.
Right. With the 3 different tax IDs.
Correct.
Sounds good. Thank you.
Okay.
All right. Thank you.
Luann, I just have one question, if you don't mind.
No.
So, yeah. So we invested, on my name, and let's say we get some 300K out of it or something like that, right? With the
Right.
profit and all. And we already have me and my wife as a joint. We have
Yep.
another LLC, and we are not 50-50 partners in there. Like I'm taking 60% and she's 40% in that LLC.
You
So-
file a joint tax return?
Yeah, we do file joint tax returns. So can we put that funds into the LLC now?
As long as the LLC passes back through to your individual social status.
Yep.
Yeah,
Yep,
as long
it
as
is.
it's what we call a disregarded entity, then yes, you absolutely can.
Okay. So from the single, it will go to the LLC, and then LLC will handle the funds from now onwards. So
Yeah.
Okay.
Yeah.
All right. That sounds good. Thank you.
You're welcome.
All
So we
right.
have to talk football for a minute.
Sure.
We do, because my youngest son's name is David Blough,
Oh.
and he got promoted. He's only 30. I'm pretty proud, but he played quarterback at Purdue, which is kind of how I got into this business, which we don't have time to go into. But then he played for the Lions, the Vikings, the Cardinals, back Olympians, and now he's the offensive coordinator for the Washington Commanders.
Wow, that's amazing.
I know it is.
Yeah, I have a follow-up question. It's a really nice session. I have a follow-up question to Srikant's question. So he just mentioned that like once you do 1031 exchange from a individual taxpayer ID to an LLC disregarded entity, later if he wants to add his friends, so what was the solution you have mentioned? I did not
Well,
follow
I
that.
didn't
Could you
really
mind
mention-
repeat it?
I didn't really mention the solution, but if you want to change the LLC, what we would suggest, so she asked if you could add people down the road to your, change it. So what we would suggest is that you hold it in that individual LLC for at least a year and a day. And I probably should have clarified that earlier on. It's usually a year and a day to qualify for long-term capital gains. So hold it the way that you bought it for a year and a day. And then if you want to change the ownership, but make sure you hold the property in the ownership the way it's been changed for another year and a day. And then the taxpayer ID for the entity that you move it into is going to have to do the exchange into the new property.
So we had to sell that newly bought property, keeping it for 1 year, 1 day, and making it long term, and then do the 1031 exchange to different property, and then add friends to it. That is what you mean to say, if I follow.
I mean to say, if you exchange into a new property as an individual, you want to season it. You want to season it for a year and a day, so that you will have held it in the tax parity that you bought it in for a year and a day. And then if you choose to change it after that, you can change it, but make sure the new entity holds the property for another year and a day before you sell it.
Got it. Yep. Thank you.
Okay.
All right, we are on time. Thank you, Luann, for the wonderful session today. And thank you, everyone, for joining us today. So we hope you all found the webinar useful and informative and helpful today. So we'll be sharing the webinar and the slides and Luann's contact information in the group, so you can reach out to her for any other questions. Thank you all. Have a great evening. Bye.
Thank you. Bye.
Thank you.